Hello everyone, it's me the Boss Hog, and today I'd like to talk about my buys, sells and dividends over the last 2 weeks, seeing as I didn't do a video last week. It's been pretty interesting, mostly green with a few really significant earnings drops, one of which was so bad I decided to sell out of my position. Let's do it. Alright, so last weekend my wife and daughter were sick. I was actually fine, but obviously I had some additional responsibilities there to take care of them. All that aside, actually last week was really strange because I was flat on the week. Technically I earned 48 pence, but it got rounded down to 0. So that was pretty interesting. Here I've done the last 2 weeks, and you can see that because I had an overall profit of 4.6k, that all came in the second week, and ultimately that was a combination of actually fairly favourable FX movements. That was especially the case on the week before, but actually really where I've become quite overweight in my tech sector, especially semiconductors, they did pretty good. And actually one or two of my consumer discretionary stocks, which have been quite beaten up, also had pretty good couple of weeks as well. So all that managed to offset some of the very significant earnings falls, which actually caused me to sell out of one of my positions, which you'll see in just a second, just because I thought it was dreadful. No capital added. This was expected. I have been mentioning that July is a very expensive month for me for multiple reasons. I'm still 5 days ahead of schedule just because sort of April to June I was able to get ahead. I'm just waiting for some money, basically about 1.5k from pet insurance that I had to pay out in advance, as well as some remortgage money, some of which is going to go into stocks. Most of it has another purpose, but I will be adding a little bit from that as well. So, actually I get paid at the end of next week, so I expect to be adding some more stocks then as well. However, I did do some selling this week, including selling out of that one position that I mentioned. Not a massive week comparatively. This represents about 1.5% of my portfolio, so also not trivial either. A lot of that was just sort of doing some trimming, because as of next Monday, I entered restricted trading. My wife's about to start a job at a private equity company, which means I'm impacted by that, basically. I have to be very careful on what I buy. So single stocks that aren't drips are going to be off limits, except from a few rare circumstances. So I might do a video talking about that for anyone who's interested in what restricted trading looks like, and the rules I have to operate by, etc. I guess actually if that would be of interest to anyone, put it down in the comments below. One dividend this week as expected. This is my last sizable one for the month. I do have a very small one for Micron next week, but this was my last sort of what I would call material. This went actually into Phoenix. I decided to put it rather than back into MPW. They're very similar in terms of my investment approach here. They yield the same. They're, in my opinion, undervalued by about the same. I just decided that as sort of Phoenix has got an upcoming dividend, which is quite sizable, about 4%, and that mixed with FX, the dollar being quite strong, meant that I just felt kind of okay putting it into Phoenix. So that was my thinking there. So that's a summary. Anyway, let's have a look at my buys and sells in a bit more detail now. Alright, so shares I bought, I'm going to just talk about the ones in green just because I feel like I've spoken about the ones in white before. I like them both. I think they're both undervalued. That's enough said about the ones that I haven't highlighted green. First up is DLR. I really wanted to increase my position in this quite materially before I entered restricted trading. I like DLR under 130. I've been picking this up at around 127. My average on this now is 130, so that feels pretty good. So I'm down a fraction, but not too much. I'm very supportive of data centers as a key part of future infrastructure. I think DLR are well placed. It's a similar argument actually I have for Micron. I think that they're transitioning to become primarily a data center business. Obviously it's all about the storage, but their chips are being increasingly used in that environment, which I think also moves them away from the cyclicality that they've been seeing in the past. So to me, like, DLR is already a very kind of reliable stock. For a REIT it's quite expensive, but I think it's kind of justified. And again, I think it's good that I've been able to buy about a 10% discount on its 5-year AFFO, so that feels great. Micron, I think, has been cheap. I used this a little bit of a fall to increase my position. Got 68 shares in this now, so actually a fairly sizable position in my portfolio. And yeah, I was buying at like 61.50, which feels great for me. I'm about flat on Micron at the moment, and actually on DLR as well. So it was really just a case of I wanted more exposure to data centers before I enter that restricted trading. Next up is Huntsman. It is my only industrial. As I've mentioned before, it has been my best performing shares, or stock, sorry. I sold out entirely last year and took sort of a 60% profit, give or take, for about £4 grand. I've been buying again, originally in the low 30s, but I've been loving picking up shares in the high 20s. I still like this stock a lot. I think it should be around $36 as its share price. Yeah, and I just thought it was a great thing. I was able to pick up some more shares basically. So brought my average down slightly. My average is at $31 at the moment, but again, I feel absolutely fine with this, dividend paying and moving in the right direction as a business, in my opinion. Next up, I got Phoenix. So as well as putting my MPW dividend toward this, I have just been buying from some of the stuff I sold as well. I've been getting my average down, which is now at 617. And these shares I bought under 6, so again, that feels great. And I do get dividend from this as well. It's an 8% yielding business. Traditionally a very conservative life assurance business, but it's been buying sort of investment companies and has positioned itself quite well. They call it sort of proving the wedge, which is basically as their heritage business, to use their word, runs off, and it will basically go to zero over time, their investment business will pick up, and so they're becoming a kind of sexier business. It is a transition business, but they're doing it in such a way that's a very safe kind of transition. They've got the better part of $2 billion in cash available. They're looking at acquisitions in the wealth management. They bought a couple of big ones, notably Standard Life, which many people in the UK especially will know, as well as Swiss Re's reinsurance business as well. And they're actively looking at acquisitions at the moment. Their last earnings, some of the analysts were talking about whether they could consider buybacks because, you know, like at the moment they've just got a lot of cash more or less sitting around not doing anything. Phoenix were a little bit resistant to that. They sort of said, you know, we don't really know when those opportunities will come around, but there are literally hundreds of smaller companies that will just be able to buy when an opportunity comes up. And, you know, we're actively looking, and, you know, we have a war chest for it, basically. So, again, 8% dividend, very conservatively run. I think it's moving in the right direction likewise. And also, as well as having that big fat dividend, I think it's about 20% undervalued. You will find extremely wide ranges for Phoenix. I think it's a unusual business and it's difficult for people to get their heads around, including analysts, I think. So the ranges here go from anywhere from about £5 to about $8.50. And also, if you try and look at things like Simply Wall Street, it's like it doesn't work, basically. Simply Wall Street's numbers are ridiculously wrong. So it's like, for whatever reason, the business is difficult to value. I've had to go at a bit of a stab in the dark, I admit. I'm going to go on their next earnings calls, which I think are at the end of September or early October. And yeah, and basically give my opinion. One of the nicer things about Phoenix as well is that they do like a video earnings call, so you can see the one from March on their website. It's good. And it's a very friendly, by UK standards, investor relations page as well. Not too surprising because about 90% of the business is owned by institutions, but it just stands out to me from the earnings calls and the investor relationship pages that I've been on. So they've been my buys anyway, and my rationale for them. Like I said, I did do a bit of selling this week, so let's have a look at my sales next. All right, so first up, anything white here is basically rounding. Again, restricted trading. I'm a bit of a stickler for not having like long decimal places unless I can get away with it. I would note I did sell 1.5 of Amazon to sort of round it down, and that was just because, again, I wanted to buy a few things. So Amazon, I'm up like 10% on all of my big tech at the moment because of when I got in. Basically, it was quite fortunate. So I did do a little bit of profit taking, but most of it's just rounding down to the nearest next figure. So in detail then, we've got Redrone. So this is a UK house builder. I decided to sell quite a lot of my position here. So from 420, I sold 120. My reason for this is where the share price has been going down, I'd been averaging down. And my original plan with this was to have it at 1.5% of my portfolio. But a combination of me adding shares and then it recovering meant that it was like 2.4% of my portfolio. So I just was like, well, hang on, I'm now up about 7% on my position. By selling these, I do disqualify myself from about 20p dividend for each of these, you know, upcoming in a couple of months. So I probably have costed myself for about 25 quid, but again, I think I've made sensible movements to address that, and I think that's a defensible position. And again, I put this into DLR, which feels fine as well in terms of its direction. So that was my decision here. Basically, was a little bit of rebalancing, some modest profit taking. Redrow, by the way, a couple of weeks ago, and I'll talk about this more in a second, announced some buyback news, as well as kind of confirming that their last year will be really good, and forward guidance was positive as well. And again, I maintain my position that house builders in the UK are a place you want to put some money at the moment and are overly beaten up. Is my general takeaway, and Redrow is my pick. But again, I think most of them offer a good opportunity at the moment as well. So that was my decision, and like I say, my average here is in the 540s now. So it was about 542. So a modest profit take here for a company I've owned about 6 months. So again, I felt it was perfectly defensible opportunity to do profit taking, and I don't plan to sell any further. Right, I have 300. It's a 5.7p, 5.7 pounds when I sold this, so it works out about 1.5% of my portfolio as well. Right, so the one that was pretty shocking to me is S4 Capital. I decided to sell my position actually at quite a chunky loss, so about 65% loss here. That's roughly speaking about 1.3k, something like that loss. So that's pretty painful when you consider that that's about 1% of my portfolio value at the moment. So quite chunky. To me, it was just more examples of what I consider very poor governance within S4. This is a company that is led by an industry stalwart, and basically that was my reason for investing in it. But what's becoming increasingly apparent is, yeah, okay, sure, the guy probably knows how to sell, but it seems like there's no checks on that, and to me that's like worrying, because I'm assuming what's happening. Maybe I'm reading too much into it, but basically there was either a sort of arrogance that said that I don't really need these controls, or nobody else is powerful enough in the company to stand up to, Sorrell, the CEO, which to me, either of those scenarios is worrying, and probably means it's going to continue for the foreseeable future. Unless they bring in like a CFO from a FTSE 100 company, I just have no confidence anymore that it's not going to continue to be more of the same. This is a company, by the way, that's lost about 80% of its value, or even more than that, since its highs. And after its latest warnings about profit reductions and hiring freezes and cost increases, it crashed like 35% in a day. And again, for me, this was just yet more examples of a company that doesn't have the right controls in place. If I'm honest as well, like, advertising isn't really an area I feel super comfortable in, and I was really just backing the man. And even though I think like Sorrell has achieved great things and deserves his knighthood, it's worrying for me that there isn't seemingly this repeat of what he was able to build previously. And to me, yeah, it just smacks of a company without good governance, and that's really concerning for me. So I decided actually to crystallize a loss. Again, with one eye on restrictive trading as well. It's going to mean that I just can't respond to anything else, and because I've lost confidence in the business, it was just a time for me to accept my losses basically, and probably accept I shouldn't have been in advertising, which is a sector in a business I don't really get fully, and this is literally all this business does, right? It's digital advertising as well, and again, it's not my core expertise at all, very removed from it in fact, and just losing confidence in a business sucks. But that was my decision to accept that loss anyway. So those are my buys and sells. Next up, let's have a walk through my portfolio very quickly, as well as a few highlights on top of that as well. All right, so this is my portfolio. Now, first of all, because I didn't do a video last week, but I do record my weekend figures. What I've decided to do here is show you my weekend in the 8th, 15th and 22nd. So you would have already seen the 8th on the video 2 weeks ago, but you haven't seen the 15th yet. And then the 22nd obviously is the one that just ended. In terms of trading, it basically wraps up the last 2 weeks. So this column basically equals everything we just walked through, right? You'll see the pluses and minuses will relate to the buys and sells. And then the plus and minus, both in terms of the pounds and percentages, that's comparing just the 15th to the 22nd, so my week-on-week difference, just to explain that method effectively. As a reminder as well, on the left there, you'll see earnings updates when they're due, ex-dividend dates and dividend payments. The earnings, especially at the moment, especially for UK positions, are a little bit sketchy. Most of the US ones I've been able to sort of scrape from Yahoo Finance, and then the dividend stuff is from Dividend Map, so that should be reasonable guidance there. So next week you'll actually see an update as we project forward into August, so you'll see lots. But actually next week's very busy in terms of earnings calls. I'm going to go on a couple of them and give you some updates basically from that. including, I'm actually going to pick a couple that aren't particularly well covered, in my opinion, on YouTube. So I'll probably stay away from the big tech ones, but I'll do my best to bring you things like Everaz, which a couple of people have asked me about for an update, and it's pretty spicy with the Russian sanctions at the moment, as well as maybe things like the Amcor when it comes, the DLR, those kind of ones as well. So yeah, I'll get to those when I can, but there'll be a couple next week. And the ones I want to talk about, so I already mentioned about Red Road. There's not too much here. They announced a £100 million buyback. That's about 7% of their market cap, so pretty significant. And really, it was a sign of confidence. They also have, as I mentioned, an upcoming dividend as well. It's their final dividend, so it's about 2/3 of their total. It's fairly typical for UK stocks. And again, I expect that to be somewhere around 20 pence as well. So a pretty high yielding stock already. Probably undervalued. I think this is still about 10% undervalued even after its last run up following this good news. But yeah, I think it's looking good basically from that perspective. I want to talk about other earnings as well. So I already mentioned about S4 and the reason for me selling them. I also want to highlight two other UK listed companies on the smaller side that got beaten up following earnings. So I've already addressed S4. I think that was the most worrying of the three for me, and like I say, caused me to sell my position. Next up was Fever Tree, which to me is incredibly frustrating. I love the product. I think the branding is on point. To me, this is just kind of like frustrating because it feels like almost all of the parts are there to have a successful business. But, like they continue to struggle with logistics, freight costs, staffing costs. It's like, they're trying to expand, but there are real growing pains within that. I've said before, and I'll say again, I wish they would hire like an operations director from Diageo, or, a kind of logistics expert from maybe Pernod, basically get some real heavyweight in, maybe some non-execs as well, hire people who are experts in freight logistics. I don't know, somebody from like a fast-moving consumer goods company or a supermarket or something like that. Like, this is a company that kind of its products on point. Its strategy in theory is correct, but what's been happening is where their costs have been increasing, their margins have gone from sort of 30% to now actually under 20%, and in my opinion they just no longer deserve the kind of 40 to 50 multiple that they've been commanding in the past. There is a lot of like jam tomorrow promise with Fever Tree, and I was tempted to average down. My buy price is in the 1300s, and after a really big drop to under £9, as in £13 to £9, it has stabilized close to £11, so I'm only down about 15% on this, on a relatively small position. But I just decided that I think it does still have a lot of upside if you're brave and believe the message, but I've been disappointed now for a couple of quarters, and until I start to see the results, I'm not prepared to sort of put more money into Fever Tree. Also, I would add as well that none of this should have been a surprise, and actually only a couple of months ago they did a fairly chunky special dividend, like 50p a share. So considering now the shares are like £11, it's like, well, couldn't you have used that for other things? It just seems like poor planning, poor expectation management, etc. So not quite as bad as S4, where it just looked like a basket case to me. Like Fever Tree has like, it's still got its original founders in there, yeah, and I think maybe the business has got a bit big for them. But again, I still like the direction. I think they kind of know what they want to be doing, but they need somebody sort of who can do the details and kind of like, those important things. Like strategy is one thing, but actually operational management matters, especially when you're trying to expand. Where I would say I am kind of confident is a bit like Games Workshop, who kind of gone through this journey as well, but actually are a bit more mature as a business, and I think their CEO is fantastic actually. So I think like Games Workshop now, you're really starting to see some confidence coming up to earnings. They already did a trading statement that seemed positive, and they've kind of gradually overcome some of those logistics and production challenges as well. They do have different challenges are not exactly the same, but likewise, costs increasing, logistics, freight costs, etc. So they've also been having similar-ish trends. Fever Tree has maybe been stung a bit more by glass, especially, which has really gone up in pricing. But I'm hoping that Fever Tree will be like another Games Workshop, and that these are kind of growing pains that are going to work through. And then, ultimately, it will be a good investment. And I think, again, if you are brave, there is money to be made on Fever Tree. But you need to have confidence that Fever Tree are going to be able to achieve their aims. And again, the aims are good. I just need to see them achieve it. So I decided to keep as was. The next one is Crichton's. So this is sort of a consumer product, basically. They've done a couple of acquisitions. Their balance sheet's a little bit beaten up at the moment. It's a very small company, so even like relatively modest acquisitions do have an impact. They did have a war chest, but now I think I'd like to see some stability from this company. And actually, when their results were first published, I had a very visceral reaction. I was disappointed because it was basically flat. But then when you look into the numbers and the earnings updates, there's a lot to like, and I think like the market had the same visceral reaction that I did, but hasn't yet responded in the way that I would expect. So now actually I would argue that Crichton's looks like a real could be argued to be real value. The reason that this gets a little bit muddied is because they brought a couple of additional brands, which is great, should be very accretive in the long run, and also move them more in a kind of luxury direction, I would say, as much as the hand soaps can never be luxury. My wife seems to think so I'm assuming there's a market there. But also what they've done is kind of proven their point, and this is where, when I stepped back, I realized that like Crichton's had absolutely set expectations, because during COVID they saw a significant increase in their desirability of the products, right? Hand soaps were suddenly, everyone was using them instead of the 50% that normally used them. And what they said they would do is basically they were going to replace what they class as non-core revenue with core revenue. And effectively their non-core revenue went down 97%, right? So, almost all of it's gone now. But their core revenue picked up that slack. So it was like the move in exactly the way that they described. And they've kind of proved their point, I think, and likewise, when you look at the revenue growth of their core products, it looks very good. I do have a slight concern that this is a very small business and that their earnings are under pressure because, they do have cost increases, as everyone does. But actually, unlike the likes of, Unilever or Procter & Gamble, when they try and sell to supermarkets, they don't have the same clout, right? Like the supermarkets are going to be looking to take margin from them. So I do have a little bit of concern about the size of this business in what's an incredibly competitive sector, and, with the end... Your delivery basically in the supermarkets under huge pressure themselves as well, actually making very small margins on the whole. So I do have some concerns about that. I want them to stabilize over the last year. I actually did try and buy some shares in this, but it's quite a small float, so it's hard to buy shares. Again, once I'd calmed down my initial reaction, I think there's some opportunity here to average down. My buy price at the moment is quite significantly ahead of this. I'm down about 30%, but a relatively small position. And again, I decided to keep this because once I stepped back, I realized that there's a lot to like about the updates and the direction of travel. So again, notwithstanding some concerns about balance sheet and margin compression, I think there's some good work that has been done, and actually, in credit to them, right, this is a small company that did set expectations and actually basically nailed the expectations. So fine, yeah, I'm definitely keeping in them, and of the 3 updates, theirs was the one I actually liked best once I'd thought about it. So there we go. Lastly, I just want to talk about Google specifically. So again, I'm a little bit out of date now, but I wanted to talk about it anyway. So 2 weeks ago, there was like an email that got leaked, right? And it was announcing that Google is going to be more or less having a hiring freeze in all but a couple of cases. That's never a good sign, and that combined with sort of similar now notices from the likes of Meta / Facebook, as well as Snap's kind of shocking earnings, has kind of got a lot of people concerned about tech in general, but specifically advertising tech. And now advertising is one of those spends that always feels like discretionary. If you've ever worked in a business, right, like, and you've been privy to those conversations, advertising spend is always one of those ones that, like, when it starts to get a bit uncomfortable in terms of like the financial position, it's one of the first things you look to reduce because it's difficult to measure the performance of it, and it always feels like one of those nice to have things, right? So you always have the more control functions within a business like finance. They'll be like, yeah, I don't feel comfortable spending more money on advertising, right? So it does tend to be kind of a front-leading indicator of recession and the state of the economy, as does recruitment, and vice versa, by the way, right? When those things pick up, then it's like a good sign that the economy is recovering. So you've kind of got Google here kind of announcing the hiring freeze, as well as other tech giants. And you've got the advertising slowdown worry from Snap primarily. I mean, S4 did dreadful too, right? But different world. But yeah, it was kind of like, I get people's concern about it, to be honest. I don't want to kind of trivialize that. What I would say is I do think that Google still offers the best risk reward of any of the big tech. Apple's got going to have its production and logistics problems. Microsoft, by the way, also makes about 10 billion a year from revenue. It's just, from advertising revenue. So it's not like that's trivial. It's just Microsoft is incredibly diverse and amazing. But that's not a cheap stock. And your likes of Amazon likewise has its own challenges, right? Both in advertising as well as a few other things around that as well. So I still think that Google doesn't look too expensive at the moment. I get the concerns. I think it's too early to be nervous unless we see a huge fall off in revenue in some way. So for now, I'm staying quite calm about Google. I still feel perfectly fine about it. I still think it's one of the best places you could put money in terms of the risk reward. Google is by far my largest big tech position. I've got about 3,000 in it compared to about 1,000 in the other big techs. And it's really just because I believe in what I've just said, right? I think it's the best risk reward place that you can put your money in the big techs. I do like the big techs in general, to be honest, and like I say, it is maybe I'm a bit biased because I got into them relatively recently, so all of them are sitting on pretty good margins at the moment. Sorry, I don't mean margins. I mean, it's nice and green. I'm up like 5 to 10% on all of them. So that's where we currently are. So like you can see here, I mean, a lot of these have moved in the right direction. Especially some of my larger and some of my more beaten up shares of up, between 5 and 10%. So that feels really great. Very few reds this week, and where they are red, they didn't matter too much in the scheme of things, right? So that's more or less how that felt. So like I say, the last 2 weeks as a whole felt really good. Even 2 weeks ago, where I finished the week flat, I actually felt amazing because it was a really rough week and I kind of got rescued by Forex difference between the dollar and the pound. This week, it felt like a lot of the kind of ways I've been building my portfolio in terms of the semiconductor space and the, I think actually consumer discretionary is overly beaten up at the moment. I think people are still willing to spend disposable money on things like bowling, on miniature figures, on things that they really like. Good affordable family entertainment is still desirable, and so I think that whole segment is a bit beaten up. If you can find companies that are in good positions and offer good values or have pricing power, etc. And more generally outside of the semis, tech in general has been pretty good this week as well, so this fortnight I suppose. So overall I felt really great about this fortnight. And to be honest with you, since Russia's invasion of Ukraine, where my mining stocks got really hammered, I felt like I've made a lot of the right moves to recover from that. Didn't panic, and basically have been catching back up on the indexes in terms of my comparisons since that event, which did kind of cause me to be running ahead to running behind, and now I'm catching back up again, and that's still been quite consistent over the last 3 months. So feel actually quite good. I'm not sure if this is the end of the bear market. I'm personally not believing it is. I think we've still got at least another 6 months of what's going to be quite volatile. We'll see what happens with earnings, with geopolitics, with inflation, with everything else that's happening, right? But right now, it's just a case of trying to make the best moves we can. And broadly speaking, I think I've made some good moves. So I feel confident. That I think is a nice way to finish it up. I hope everyone else had a good couple of weeks as well and is feeling broadly mentally good about how their investments are going. Any comments, questions, anything else, normal stuff in the spaces below. I've been the Boss Hog. Thanks very much for watching, everyone, and good luck with your investing. Bye for now.